Hedge fund innovations in 2025. Navigating the new investment landscape. Introduction to the evolving world of hedge funds. Picture this. It's July 2025, and amidst record market volatility, a certain group of equity hedge funds delivers nearly 8% returns year to date while major indices struggle with uncertainty. This isn't luck, it's the result of profound innovations transforming the hedge fund industry. Welcome everyone. Today we're exploring exactly how hedge funds are evolving to not just survive but thrive in today's complex markets. The industry is currently undergoing its most significant transformation in decades, moving beyond the traditional 2 and 20 inches fee structure into a world where technological sophistication, strategic creativity, and operational flexibility separate the winners from the losers. What's particularly fascinating is that we're seeing innovation occur simultaneously across multiple dimensions: technology, strategy, and structure. This trifecta of transformation is creating both tremendous opportunities and significant challenges for funds and investors alike. As we dive into these developments, I'll highlight not just the what, but the so what, the practical implications for market participants and what these changes signal about the future of sophisticated investing. The industry has grown to over $4.5 trillion in assets, but size alone doesn't tell the story. It's the qualitative shifts in how these assets are being deployed that reveal the true revolution underway. The new market reality. Understanding the context for innovation. Before we examine the specific innovations, we need to understand the environmental pressures driving them. The investment landscape has undergone a fundamental regime change characterized by three key elements: the end of easy money, geopolitical fragmentation, and technological disruption. We've transitioned from a period of suppressed volatility during the quantitative easing era to what many are calling the age of volatility. As Don Steinbrugge of Agecroft Partners notes, this volatility creates a double-edged sword. While it can pressure equity and fixed income valuations, it also creates more opportunities for skilled managers to generate alpha through significant price distortions. This environment particularly benefits strategies designed to capitalize on dislocation, such as long volatility approaches employed by commodity trading advisors. The geopolitical landscape has become increasingly complex with tariff disputes, shifting alliances, and regional conflicts. The Trump administration's policies, regardless of your political perspective, have introduced significant uncertainty into global trade relationships. Meanwhile, events like the Russia-Ukraine conflict and tensions in the Middle East create energy price shocks that ripple across asset classes. For hedge funds, this means traditional correlation assumptions often break down, creating both risks and opportunities. Perhaps most significantly, we've moved from a zero interest rate environment to one where risk-free rates sit at 4% 5%. This seemingly simple change has profound implications for hedge fund strategies. Suddenly, approaches with significant cash holdings, like market-neutral long, short equity, commodities trading advisors, and reinsurance funds, generate meaningful returns on their collateral without taking additional market risk. This carry component can provide a crucial buffer during periods of market stress. The technological arms race. AI, data, and the quest for alpha. The most visible area of innovation lies in technology, where hedge funds are engaged in what can only be described as an information arms race. The goal is simple: process more information, faster, and with greater insight than competitors. The reality, however, is incredibly complex. Leading funds are making massive investments in artificial intelligence and machine learning capabilities that go far beyond traditional quantitative analysis. The question, can AI outperform human investors, is being tested daily in real-world conditions. These systems can analyze alternative data sources ranging from satellite imagery and social media sentiment to credit card transactions and supply chain information. One fund might use computer vision to analyze parking lot traffic at retail locations, while another might process natural language from earnings call transcripts to detect subtle shifts in managerial confidence. What makes this an arms race is the transient nature of any advantage. As quickly as one fund develops a novel data source or analytical technique, competitors work to replicate or surpass it. This dynamic has led to the emergence of data scientists as key positions at leading firms. These professionals aren't traditional portfolio managers. They're specialists in extracting signal from noise across diverse information ecosystems. The practical application of these technologies is creating a new generation of systematic investment processes that are fundamentally different from both discretionary management and traditional quant approaches. As one research paper describes, successful systematic hedge funds maintain research and development (R&D) process to continually build and refine a library of alpha sources and components, including proprietary construction of classic factors and risk premium. This systematic approach naturally reduces cost pressures associated with decentralized multi-asset management structures while creating more scalable processes. Innovative strategies and approaches, from systematic cores to new asset classes. Beyond technology, we're seeing fascinating innovations in investment strategy and portfolio construction. The traditional boundaries between hedge fund categories are blurring as managers develop hybrid approaches tailored to the new market reality. One significant development is the rise of systematic core and core satellite strategies. This approach aims to deliver superior returns through a repeatable, risk-managed methodology that provides added value to clients. The core idea is maximizing edge through breadth, spreading independent bets across expansive investment universes over time. This isn't just about being quantitative. It's about creating a framework that can systematically identify and exploit opportunities while carefully modeling trading costs and position sizing relative to available liquidity. Another area of innovation is the incorporation of digital assets and blockchain technology into traditional strategies. With support from pro-crypto policies, the industry is witnessing significant growth in funds dedicated exclusively to cryptocurrencies, while various hedge fund strategies, including commodity trading advisors, global macro, and multi-strategy funds, are increasingly incorporating cryptocurrencies into their portfolios. Some investment funds are even introducing Bitcoin share classes alongside traditional currency denominations. Strategy innovation also extends to previously niche areas like reinsurance and insurance-linked securities. After a period of underwhelming performance driven by historically low pricing, this sector has rebounded sharply with pricing doubling or more from its lows in certain cases. The attraction for hedge funds is clear: uncorrelated returns derived from insurance risks rather than financial market movements. With traditional asset classes becoming less attractive due to rising valuations and tight credit spreads, these alternative risk premia are drawing substantial capital inflows. The hedge fund industry is currently experiencing a wave of strategic innovation, each offering distinct practical applications and benefits. Systematic core strategies, for instance, involve building diversified portfolios through repeatable, risk-managed processes, providing scalability and consistency across varying market conditions. Another key innovation is the integration of digital assets, such as cryptocurrencies, into global macro and multi-strategy funds, allowing managers to gain exposure to non-correlated return streams. Reinsurance strategies have also emerged as a powerful tool, enabling funds to capitalize on hardened pricing in insurance markets and generate returns derived from insurance risks rather than traditional financial markets. Relative value credit strategies exploit dislocations when companies refinance debt at higher rates, allowing investors to benefit from stress in credit markets without directly facing outright defaults. Beyond these investment strategies, hedge funds are also embracing structural and operational innovations, reshaping their architecture to become more adaptive, efficient, and capable of leveraging these advanced approaches in a rapidly evolving financial landscape. The innovations aren't limited to what hedge funds invest in, they extend to how hedge funds are structured and operated. The traditional model of a star portfolio manager operating with minimal constraints is giving way to more institutionalized approaches. The most discussed structural trend is the continued rise of multi-strategy, multi-manager platforms. These organizations host numerous portfolio management teams operating within a unified infrastructure. What's particularly interesting recently is how these behemoths are evolving. There's growing sentiment that the largest platforms have become overcapitalized, leading to diminishing returns as portfolio teams face capacity constraints. This has sparked two countervailing trends. First, increasing demand for smaller multi-strategy funds that leverage external managers, and second, the largest multi-strategy funds themselves becoming significant allocators to external hedge funds. This evolution has created what some are calling the multi-strat as allocator phenomenon. Firms like Millennium Management have deployed at least $20 billion in assets to more than 50 third-party managers. This isn't just about deploying excess capital. It's a sophisticated approach to accessing niche strategies and emerging talent that doesn't fit within the core platform. For startup managers, this represents a crucial source of institutional capital, with firms like Tala Capital and Jane Global receiving billion-dollar allocations that would have been unthinkable a decade ago. Operationally, we're also seeing innovation in how hedge funds interact with investors. There's growing demand for separately managed accounts which offer investors greater flexibility on fees and liquidity terms. For hedge funds, these structures create operational complexity but also provide a vehicle to showcase strategy implementation with greater transparency. Similarly, interval funds and other registered vehicles are making hedge fund strategies accessible to private wealth channels that previously lacked access. The evolving role in portfolios. Hedge funds as risk mitigators. Perhaps the most significant shift has been in how institutional investors perceive and utilize hedge funds within their portfolios. The traditional, alpha-chasing, approach has evolved into a more nuanced appreciation for hedge funds as risk mitigation tools. This transition became particularly pronounced after 2022, when both stocks and bonds declined simultaneously, breaking the traditional 60/40 portfolio model. This failure of conventional diversification highlighted the necessity of alternative strategies that offer genuine decorrelation from traditional assets. As a result, influential limited partners like CalPERS and Ohio PERS are plotting significant moves back into hedge funds through dedicated risk mitigation sleeves. The appeal is straightforward. Hedge funds delivered 10.12% returns in 2024 with a fraction of the volatility of global equities. This performance, combined with their liquidity advantages over private assets, has repositioned hedge funds as a crucial component of institutional portfolios. According to research, 36% of allocators with oversight of hedge funds will commit new capital into the industry in 2025, with a further 43% looking to invest opportunistically. This role shift has corresponding implications for which strategies are in demand. Relative value, trend-following CTAs, macro, and risk premia strategies are particularly sought after for their diversification benefits. Meanwhile, within equity strategies, there's growing emphasis on market-neutral and low-net approaches that can provide equity-like returns with bond-like volatility. Conclusion. Synthesizing the innovations and looking ahead. As we've seen, the hedge fund industry is in the midst of a remarkable period of innovation spanning technology, strategy, and structure. The common thread connecting these developments is adaptation to a new market regime characterized by higher volatility, geopolitical uncertainty, and normalized interest rates. The technological arms race in artificial intelligence and data analytics is creating increasingly sophisticated approaches to alpha generation. The strategic incorporation of new asset classes like cryptocurrencies and insurance-linked securities is expanding the opportunity set beyond traditional markets. And the structural evolution toward multi-manager platforms acting as allocators is creating a more complex but potentially more resilient ecosystem. Looking ahead, several trends bear watching. The tension between the largest multi-strategy funds and emerging smaller platforms will likely shape the industry's competitive dynamics. The ongoing integration of AI into investment processes will continue to accelerate, potentially creating new capabilities we can scarcely imagine today. And the role of hedge funds within institutional portfolios will continue to evolve as investors seek strategies that can navigate an increasingly complex world. What remains constant is that hedge funds exist at the intersection of innovation and implementation. The best funds combine sophisticated thinking with practical execution. Theorizing about market inefficiencies is meaningless without the capability to exploit them. As we move deeper into 2025 and beyond, this combination of intellectual firepower and operational excellence will separate the transient performers from those creating lasting value. The storm of market uncertainty, as one report eloquently noted, is not merely a force to be feared. It is a moment of reckoning, a chance to strip away illusion and see clearly. For hedge funds and their investors, the innovations we've discussed today represent precisely this opportunity to see markets more clearly and navigate them more effectively. Thank you for joining me in exploring these fascinating developments.